Welcome to the debate. Imagine you have two very different machines for building wealth.
Okay.
One is a 50-year-old fortress, managing trillions of dollars for retirees. And the other is this neon-lit app that, just a few years ago was widely considered a meme stock casino.
Right, a complete casino.
Exactly. But now it's quietly building the financial infrastructure for the next generation. Today, the market is paying a massive premium for the app and heavily discounting the fortress. So are investors seeing the future, or are they being blinded by hype? We are broadcasting this on April 29, 2026, and that is the exact tension we are seeing in the market following the chaotic first quarter.
It really is the ultimate crossroads of market psychology and fundamental reality. Investors are violently testing what they are willing to pay for the promise of hyper-growth versus what they are willing to pay for rock-solid stability.
Precisely. And that establishes the intellectual framework for today's discussion. We are analyzing the fundamental clash between high expectation growth models and mature value stability within the financial sector.
Right.
Specifically, we are going to exhaustively analyze the contrasting models of Robinhood and Charles Schwab following the market turbulence we just witnessed in early 2026. This debate emerges directly from their Q1 2026 financial reporting, the latest stock performance metrics, and the valuation multiples the market is digesting right now.
Which are fascinating to look at.
They really are. So my position is that Robinhood's higher valuation multiple is entirely justified. It reflects a legitimate, scalable tech ecosystem that is rapidly transitioning into a diversified financial powerhouse.
And my position is that Robinhood's high beta growth model is largely speculative hype. It's masquerading as structural evolution, which makes Charles Schwab's stable, profitable framework the vastly superior risk-adjusted reality.
Well, let's lay out the foundation for this. If you are listening to this, you probably still think of Robinhood as the app where teenagers trade meme coins.
Most people do.
Yeah, and if this were 2021, you would be right. But the aha moment here is looking at their Q1 2026 forensic data. The numbers reveal a machine that is compounding its reach through fundamentally boring traditional banking mechanics.
Boring is definitely not the word I would use for Robinhood, but go on.
Well, boring in a good way. We are looking at $1.07 billion in revenue for the quarter. That is up 15% year over year. And an adjusted earnings per share, or EPS, of 38 cents. But the headline numbers only tell half the story here.
I agree with that. The headlines always miss the nuance.
Right. The market is fundamentally underestimating the sheer ecosystem lock-in that Robinhood has engineered. We are seeing average revenue per user, or RPU, climb to $157. They now hold $307 billion in total platform assets.
But you have to contextualize what those assets are actually doing. A massive asset base doesn't matter if you can't monetize it predictably.
Let me finish the thought, because they are monetizing it predictably. Look at how net interest revenue grew 24% year over year. That is structural, reliable yield.
Okay, but how exactly are they getting that yield?
They take the idle cash sitting in users' accounts, money just waiting to be invested, and they capture the spread in a high-yield environment. Furthermore, look at the subscription metrics. Robinhood Gold subscribers just hit 4.3 million.
Wow.
Yeah, that's a 36% surge. We are seeing attach rates reaching 16% of all customers, and an astonishing 40% attach rate for new customers. When you combine that with a newly minted $1.5 billion share repurchase program, you're looking at the foundation for massive compounding scalability.
A toll road model.
Exactly, a financial toll road. Once you're on it, you use them for everything: trading, credit, banking. Traditional brokerages simply cannot match that velocity of monetization.
That is a compelling narrative. I will give you that. But I counter that thesis with one rooted in valuation reality and the extreme danger of priced-in perfection. We have to look exhaustively at the math behind the April 2026 crash.
Let's do the math.
Currently, Robinhood trades at a staggering 39.86 price-to-earnings ratio. And, depending on whether you look at trailing or forward earnings, some data providers have them pushing 70x.
Right, trailing metrics can look a bit inflated.
Inflated is putting it mildly. Contrast that neon-lit high-wire act with Charles Schwab. Schwab is essentially a massive vault where you park your life savings and they earn a steady, predictable rent on it. Schwab offers a highly rational 17.54 PE. It actually pays you for your patience with a 1.25% dividend yield.
But comparing their PE ratios in a vacuum ignores the trajectory of their respective growth curves, doesn't it?
Well, then let's look at the growth curve, specifically through the PEG ratio. For our listeners, the PEG ratio is simply a company's PE ratio divided by its expected earnings growth rate. It's the ultimate reality check to see if you are overpaying for growth.
A crucial metric, yeah.
Exactly. A PEG of 1 means a stock is fairly valued relative to its growth. Charles Schwab sits at a comfortable 0.8, meaning it's fundamentally on sale. It offers a true margin of safety.
And Robinhood?
Robinhood sits between 1.6 and 3.6, depending on how generous your growth models are. You are overpaying for growth that is already slowing down.
Slowing down.
Yes. Schwab is offering a steady, predictable 16.4% EPS growth for 2026. And it is doing so without the immense regulatory risks or the high beta exposure that caused Robinhood to lose 16% of its market value during a brief crypto slump in February.
I see why you think that. But let me give you a different perspective on how we should interpret these multiples. Moving into the core of our debate, the merits of scaling versus what you call the delusions of hype, we have to ask whether Robinhood's price is a leading indicator of absolute future dominance or just a lagging indicator of its past momentum.
I lean heavily toward lagging indicator.
And you look at a 39.86x multiple or a 70x multiple on trailing earnings and see danger. I look at it and see the market correctly pricing a tech platform multiple rather than a legacy bank multiple. To understand Robinhood's valuation, you can't compare it directly to Schwab.
Who do you compare it to then?
You have to look at its structural peers. Look at SoFi, currently trading at a 48.32 PE. The market willingly assigns these premiums to platforms that own the entire digital consumer lifecycle.
But a multiple is supposed to be a reflection of future earnings power, not just a badge of technological superiority. Let's dissect that April repricing.
Sure.
The market didn't just wake up in a bad mood, you know? It woke up to the math. In Q4 of 2025, Robinhood showed a 35% drop in quarterly profit. Yes, they beat EPS expectations generally, but the actual quarter-over-quarter profit momentum decelerated violently.
Right, but you have to look at the annual projections.
Even looking annually, we are looking at a consensus projection of 20% EPS growth for 2026. So how do you mathematically justify a valuation multiple that is roughly double Schwab's when the earnings growth rate is moderating back down to 20%? I mean, if you are paying a near 40x multiple, you are paying for the explosive growth rate that existed in 2025, not the 20% reality of 2026.
I understand the instinct to anchor to Schwab's 17.5 PE, I really do. But applying a traditional bank multiple to Robinhood completely misses the underlying architecture of their revenue.
Robinhood isn't just a broker anymore.
It's an ecosystem.
Exactly.
It has evolved into an interconnected ecosystem operating roughly 11 distinct business lines, each generating over $100 million in annualized revenue. We are talking about equities, options, crypto, credit, advisory, margin lending.
That is a lot of different spinning plates.
It is, but they are executing. The multiple isn't just pricing in the current 38-cent EPS. It is pricing in the optionality of a platform that has millions of active nodes, users, who are increasingly adopting multiple products.
Right, cross-selling.
Yes, when a tech platform proves it can cross-sell at high margins, the lifetime value of a customer scales non-linearly. That means for every new product a Robinhood user adopts, the cost to acquire that revenue is essentially zero. That mathematically forces the PE ratio to expand.
I come at it from a completely different way. Having 11 business lines only justifies a premium multiple if those business lines produce high-quality, durable revenue. And that brings us to the exact quality of this revenue and the regulatory crucible Robinhood is operating in.
Okay, let's talk about revenue quality.
You mentioned crypto as one of those pillars. Let's look at what happened in February 2026. The stock dropped nearly 10% in a single trading session and erased roughly 16% of its value over a few days purely because of a slump in major cryptocurrencies.
It was a volatile week for the whole sector.
But look at the impact. We saw their crypto trading volume collapse by 47% during that window. That is not durable revenue. That is a high beta business model.
Just for clarity for our listeners, when we say high beta, we mean the revenue is hypersensitive to broader market swings. When the market goes up, it flies. When it goes down, it plummets.
Exactly. And worse, to replace that fading crypto momentum and mask a stalling core engine, Robinhood is pivoting hard into highly speculative areas. Just look at the Q1 numbers on event contracts and prediction markets.
The prediction markets have been fascinating to watch.
Fascinating, sure. But they saw a 320% surge in event contracts, generating $147 million.
Which proves they can successfully innovate and capture retail demand where it shifts.
I'm sorry, but I just don't buy that. Let me tell you why. Earning $147 million off prediction markets isn't structural evolution. It is an open invitation for a massive regulatory overhang. It is the absolute definition of searching for growth in the regulatory gray zones.
You really think it's just a flash in the pan?
I think you are masking a highly volatile transaction engine with speculative flash. Contrast that with Schwab. Schwab's growth doesn't depend on whether Bitcoin is having a good week or whether a prediction contract about a political event clears regulatory hurdles.
Schwab is definitely more insulated from that.
Heavily insulated. Schwab relies on deeply entrenched, diversified wealth management. They are gathering assets, earning net interest on massive, stable cash balances, and collecting advisory fees that do not evaporate overnight when retail sentiment turns sour.
That is an interesting point, though I would frame it very differently. You are hyper-focusing on the volatility of the transaction revenue, which, granted, was the story of Robinhood in 2021 and 2022. But look at the structural shift in the Q1 2026 data.
The shift to gold subscriptions?
Partly, yes. The transaction volatility you just described is being aggressively cushioned by their tech moat. You simply cannot ignore the technical architecture underneath this platform. They have transitioned a massive portion of their infrastructure to the Robinhood chain, which is built on Arbitrum Layer 2 technology.
Okay, but I failed to see how a blockchain layer solves the fundamental problem of speculative retail behavior.
Well, because you have to understand how that infrastructure impacts their margins. We are talking about 100 millisecond block times on this Arbitrum L2 network.
Right, it's fast.
It's basically instantaneous. And why does that matter? Because in the financial sector, latency is a cost and settlement times are a risk. By settling transactions almost instantly on their own proprietary Layer 2 infrastructure, they drastically reduce their clearing costs and fundamentally lower the floor of their operating expenses per trade.
So they save some money on the back end.
It's more than saving money. This allows them to pivot their focus to recurring high-margin revenue. Let's talk about the integration of the new Platinum and Gold credit cards. Those 4.3 million Gold subscribers paying monthly fees, that is pure recurring subscription revenue.
Right.
Robinhood is successfully converting high beta, unpredictable traders into stable, yield-generating banking clients. They are capturing high yield spreads on $307 billion in platform assets. That is exactly the durable revenue quality you are asking for.
But quality revenue doesn't mean anything if it costs you $2 to make one.
That's a bit of an exaggeration.
Maybe slightly. But you brought up their shift to recurring revenue and their fancy Arbitrum Layer 2 infrastructure. We have to look at what that transition is actually costing them on the back end. This leads us directly to the third critical point of our debate: operating leverage versus margin compression. You are praising their technical transition, but transitions are incredibly expensive. Let's look at the actual operating expenses.
Before we do, let's clearly establish the scale and define what we mean by operating leverage. Robinhood is pulling in $18 billion in annualized net deposits.
Huge numbers, yes.
Operating leverage is the holy grail of business. It means your revenue goes faster than your cost. For legacy banks like Schwab, historically, growing your deposit base by 20% meant building physical branch offices, hiring more advisors, and increasing human overhead.
True.
But for Robinhood, when they run a digital-first infrastructure, managing millions of accounts, every incremental dollar of deposit theoretically drops straight to the bottom line because the app is already built. They don't have to build physical branches.
That's a compelling argument in theory, but have you considered the actual Q1 2026 reality?
I have the numbers right here.
And you know, operating expenses were up 18% year over year.
The theoretical leverage you were talking about is eroding in real time. The company just raised its full-year 2026 adjusted OPEX guidance to a staggering $2.7 to $2.825 billion.
They are investing heavily.
And where is that money going? They are burning $100 million right now on strategic initiatives, like developing a specialized government youth investing app project. They are literally buying their growth at the expense of their profit margins. You cannot claim massive operating leverage when your costs are rising 18% to support a 15% revenue growth. The math is inverted.
I wouldn't call investing in the next generation of users burning money. It's a calculated customer acquisition cost. Getting young users onto the platform before they even have significant capital, well, it guarantees a decade-long payback period. It feeds directly back into that non-linear lifetime value we discussed earlier.
But the market is pricing their stock as if that payback is happening tomorrow. You cannot have profit growth decelerating, operating expenses climbing 18%, and still command a 39.86 multiple. That is the fundamental disconnect I am pointing out.
And Schwab is doing it better?
Yes. Meanwhile, look at Charles Schwab. Schwab is benefiting from true operating leverage. As the markets normalize following the severe banking stress of 2022 and 2023, Schwab's fixed costs remain stable. Their massive multi-trillion-dollar asset base compounds quietly.
Quietly being the operative word.
Quiet but profitable. That is why Schwab can confidently project mid-teens EPS growth, 16.4% to be exact, on a massive, highly profitable base. Schwab doesn't have to spend $100 million on a youth app to sustain its valuation. It just executes its core wealth management business.
I'm not convinced by that line of reasoning because it completely ignores the trajectory of the modern consumer. Yes, Robinhood's OPEX is up 18%, but their revenue was up 15%, even in a quarter where they suffered a massive 47% crypto volume collapse.
That's true. The revenue held up better than expected.
Let that sink in. Their most volatile segment collapsed by half, and top-line revenues still grew by double digits. Their net deposits are annualizing at 20%. The fact that management initiated a $1.5 billion share repurchase program in March 2026 proves they have immense confidence in their free cash flow generation.
Or they're just trying to prop up the stock price.
I disagree. They aren't just buying growth blindly. They are buying back their own equity because they know the market is mispricing the long-term value of their interconnected ecosystem. Schwab is a phenomenal machine for the previous generation's wealth, but it operates with a PEG ratio of 0.8 because the market knows its growth is fundamentally capped by its demographic.
Capped but consistent.
But Robinhood's PEG of 1.6 to 3.6 reflects the reality that if they successfully cross-sell 27.4 million users into credit cards, banking, and equities, their earnings won't just grow by 16% a year. They will scale exponentially.
Exponential, non-linear scaling is a wonderful concept for a Silicon Valley slide deck, but the public markets demand linear, predictable accounting.
Sure, but
Let me finish this point. When Robinhood's forward PE sits near 40x and Schwab sits at 17.5x, the margin of safety for a Robinhood investor is essentially zero. If those $147 million in prediction markets face an SEC crackdown, which is highly probable, or if crypto enters another prolonged winter, that multiple will contract violently.
we've seen multiple contractions before.
We already saw it happen in March and April. The stock lost a massive chunk of its value from its recent highs precisely because the market realized the post-meme rally of 2025 had artificially pulled forward years of future returns.
And yet, despite that multiple contraction, Q1 2026 still showed positive earnings growth at 38 cents EPS and expanding absolute profits. They are still growing. The market is just recalibrating the velocity of that growth, shifting its expectation from hyperspeed to a more sustainable, methodical expansion.
Recalibration is just a polite Wall Street word for a crash driven by overvaluation. Schwab offers genuine value and stability. Over the last 2 years, Robinhood swung wildly, crushing Schwab on the way up in 2025, but swinging much harder on the downside, dropping roughly 25% year-to-date in early 2026, while Schwab was down only about 9%.
The volatility is a known factor.
But the math doesn't lie.
In a macroeconomic environment that is punishing overvalued hype and demanding actual profitability, Schwab is the vastly superior risk-adjusted value play.
Well, let's bring this to our conclusion. My position remains that Robinhood is navigating a profound structural transformation. It is transitioning from a transaction-dependent brokerage into a diversified, subscription-heavy financial ecosystem fortified by cutting-edge Arbitrum Layer 2 infrastructure.
The tech is impressive, I'll give you that.
And thank you. And the 36% growth in Gold subscriptions, bringing them to 4.3 million loyal users, the ARPU climbing to $157, and the massive $307 billion in platform assets, all of that justifies a premium valuation. It is a unique growth asset, and while the multiple is admittedly high, it is the price of admission for a company building the financial infrastructure for the next generation.
And my position remains that a great narrative cannot suspend the laws of financial gravity indefinitely. When you have a PEG ratio pushing past 3, slowing profit growth, operating expenses climbing by 18%, and a pivot into regulatory gray zones with event contracts to mask a fading core engine, you are looking at a highly speculative asset.
We clearly see the risk profile differently.
We do. Charles Schwab, trading at a sensible 17.5 PE with steady 16.4% EPS growth, provides the genuine operating leverage and durable profitability that serious investors require.
I think where we do find absolute convergence today is in acknowledging that Robinhood has fundamentally evolved. Whether you view that evolution as a durable, technologically superior moat or a speculative pivot fraught with regulatory danger, the company of April 2026 is vastly more complex and diversified than its meme stock origins.
Agreed. It is no longer a single-trick platform. The 11 business lines prove that, even if I fundamentally question the exorbitant price the market is paying for that complexity.
Right. And understanding both the aggressive growth narrative and the rigorous value investing perspective is essential for dissecting these modern financial markets. There is so much more to explore in the underlying material, particularly regarding how macroeconomic environments like fluctuating interest rates and inflation will impact the deposit margins for these two distinctly different brokerages over the next few years.
It truly is a phenomenal case study in market psychology versus fundamental analysis.
Now, before we close, a mandatory investor disclaimer. This discourse is for educational purposes only. It is not personalized investment advice and does not account for your specific risk tolerance, time horizon, or tax situation.
Yes, always do your own research.
Exactly. Please review the official 10K and 10Q filings. Cross-check valuation metrics across multiple platforms, as they can and do vary, and consult with a licensed financial advisor before investing in Robinhood, Charles Schwab, or any other company.
So, as you look at the financial architecture of tomorrow, do you want to pay a premium to ride the toll road of the future, knowing the bridge might still be under construction, or do you park your capital in the impenetrable, dividend-paying vault?
A question every investor must answer for themselves. Thank you for joining us on The Debate.